David Macdonald is a senior economist with the Canadian Centre for Policy Alternatives. He was actually in the lockup today with our team as the economic update was released for early viewing. So David, thank you for being with us really all day and joining us once again right now.
Sure thing. Thanks for having me.
Now, we had some idea going into this update today about the details, the issues that the government wanted to highlight with this update. Anything stand out for you?
One of the things that was legitimately new was this permanent now forgiveness of student loan interest. This was something that was done on a temporary basis during the pandemic, but now it seems like it'll be permanent. It doesn't go as far as what happened in the U.S., where you saw a forgiveness of big sections of student loans of $15,000 in the U.S. We're not seeing that here. This is sort of the minimum, I suppose, that they could do on this file, but still taking some, an interesting new step for something we saw during the pandemic. One of the other pieces I thought that was interesting was this new tax on share buybacks. This is a technical way that companies can take the profits that they have made and pay them to investors. And so it's a recognition that if that's what companies are doing, they're not taking those profits and reinvesting them in the economy and their own companies to make their companies and the economy more productive. And I think it reflects a skepticism of this government, and this is potentially the NDP influence of the corporate sector, that initially the corporate sector in the early 2000s got huge corporate tax cuts. They said that they were going to invest that in the economy and in their companies. Didn't really work out that way. And so we're seeing higher corporate income tax rates on the banks, which was introduced in the spring budget, and then this new sort of slightly higher tax on, or tax at all, frankly, on share buybacks. It's actually twice the amount that they introduced in the U.S. at 2% versus the American tax, which is 1%.
Now, the minister did say that she believes Canada is well prepared to meet any economic challenges ahead, and that is what we're being prepared for, economic challenges. Do you agree with that assessment, given our fundamentals, when you compare to the economic performance of other G7 countries? How well positioned is Canada to deal with an economic storm?
Certainly when it comes to the downturn and recovery of the pandemic, Canada was decidedly mid-range. Certainly in the last 2 quarters, we have performed better, but you're sort of cherry-picking the last couple quarters, even though that's what the budget does. In terms of inflation, our inflation has been high, but it certainly hasn't been as high as we're seeing in European countries that are facing much higher natural gas prices than we are here, and therefore much higher power and electricity prices in general. That being said, our interest rate is going up faster. And so despite the fact that we're not seeing the highest inflation rate, we are seeing some of the highest interest rate hikes. We have to remember that this recession isn't due to some weakness in the Canadian economy. It's a recession engineered, created by the Bank of Canada right here in Canada due to higher interest rates. And so while we may be going into this recession with a relatively tight labor market and strong GDP growth so far, if the interest rates bite the way that the bank thinks they will, it may well be that this will push us further behind other countries, even if we started out a little ahead.
Okay, that's the country writ large. What about individual Canadians now? If we are headed for some bad economic times ahead, did the government exercise enough of its fiscal powers to make sure Canadians are prepared?
Well, we've seen the 3 measures already that the federal government is pitching for their sort of anti-inflation or inflationary offset transfers. This is the GST top-up, which comes out today or tomorrow, the $500 for low-income renters, and the dental insurance for low-income families with children. Those are good measures, and for the families that receive more than one of them, it'll make a difference in terms of offsetting the increase in costs they've seen over the course of the past year. Now, to some degree, that's looking backwards. If we are to look forwards towards a recession, one of the things that we need to take into account is the fact that the major EI enhancements and CERB, that's all been expired. It's been expired since September. So the lessons we learned in the pandemic in terms of making sure that we strongly support jobless Canadians to make sure that we get a good recovery at the other side, we've unlearned those lessons. There has been a big EI consultation over the course of this year to try to figure out how we can improve EI post-pandemic. This was an opportunity to put some of those pieces into play, but that's not what happened. And so in terms of preparing for the next recession, we are going into it with the same EI system we went into the last recession, which was inadequate at that point and likely will be inadequate this time.
David, really, again, appreciate your time today. Thank you for talking to us tonight.
Thanks for having me.